Interest rates. It's a term we hear often, but what does it mean, and how does it impact our lives? Let's break it down. Imagine you borrow money from a friend. They might ask you to pay them back a little extra on top of the original amount. That extra amount is essentially interest. Interest rates are the cost of borrowing money, expressed as a percentage. When you take out a loan, whether it's for a car, a house, or even a credit card purchase, you agree to pay back the original amount, the principal plus interest over a specific period. The interest rate determines how much extra you'll pay, but it's important to note that interest rates aren't static, they fluctuate over time. Central banks, like the Federal Reserve in the United States, have the power to influence interest rates. These rates impact various aspects of the economy and personal finance, which we'll explore in more detail later. Essentially, interest rates are the price of money. Just like the price of any product can go up or down, so can the cost of borrowing money. Interest rates serve as a powerful tool for central banks to influence the overall economic climate. By adjusting the cost of borrowing, they can stimulate or cool down economic activity. When interest rates are lowered, borrowing becomes cheaper, encouraging consumers and businesses to spend more. This increased spending can boost economic growth, create jobs, and stimulate investment. However, excessive borrowing can lead to inflation as demand outpaces supply. Conversely, when interest rates are raised, the cost of borrowing increases, discouraging spending and investment. This can help to slow down an overheated economy and curb inflation. However, if rates are raised too aggressively, it can stifle economic growth and lead to a recession. Beyond influencing spending and investment, interest rates also impact the housing market. Lower interest rates typically make mortgages more affordable, stimulating home sales and construction. Conversely, higher interest rates can cool the housing market by making mortgages more expensive. Interest rates also affect the value of currencies. Higher interest rates tend to attract foreign investors seeking higher returns, which can strengthen a country's currency. Conversely, lower interest rates can weaken a currency. It's essential to note that the relationship between interest rates and the economy is complex and influenced by various factors. The effectiveness of interest rate policies depends on the overall economic conditions, consumer confidence, and global economic trends. Interest rates directly influence your financial well-being in several key ways. First and foremost, they impact the cost of borrowing. When interest rates rise, the cost of loans, including mortgages, auto loans, and credit card debt, increases. This means you'll pay more in interest over the life of the loan. Conversely, when interest rates decline, borrowing becomes cheaper, making larger purchases more affordable. On the other hand, interest rates also affect your savings. When interest rates rise, the returns on your savings accounts and certificates of deposit, CDs, typically increase. This means your money can grow faster. However, it's essential to consider inflation, as rising interest rates might not always outpace it. Moreover, interest rates can influence investment decisions. Bonds are particularly sensitive to interest rate changes. When interest rates rise, bond prices generally fall, and vice versa. This can impact the value of your bond holdings. Additionally, higher interest rates can affect the overall cost of capital for businesses, which can influence stock prices. Understanding how interest rates impact different financial products is crucial for making informed decisions. By carefully considering your financial goals and risk tolerance, you can navigate interest rate changes effectively. For instance, if you plan to make a significant purchase in the near future, you might want to lock in a fixed interest rate to protect yourself from potential increases. On the other hand, if you're saving for retirement, you might benefit from rising interest rates on your savings accounts. Ultimately, staying informed about interest rate trends and their potential impact on your financial situation is essential. By proactively managing your finances and adapting to changing economic conditions, you can increase your chances of achieving your long-term financial goals. Navigating the complexities of interest rate fluctuations requires a proactive approach to your financial planning. Understanding how these changes impact various aspects of your financial life is crucial. For homeowners, the impact of interest rate changes can be substantial. If rates rise, refinancing your mortgage might be beneficial to secure a lower interest rate. Conversely, if rates fall, locking in a fixed-rate mortgage could be advantageous. Regularly assessing your mortgage terms is essential to make informed decisions. Borrowers, whether carrying student loans, auto loans, or credit card debt, should closely monitor interest rate movements. Consider consolidating high-interest debts or exploring balance transfer options to potentially reduce interest payments. Building a strong credit score can also improve your borrowing terms in the future. Savers can benefit from rising interest rates as savings accounts and certificates of deposit, CDs, often offer higher returns. However, it's essential to balance the desire for higher returns with the need for liquidity. Diversifying your savings across different accounts can help you manage risk and optimize returns. Investors should also pay attention to interest rate changes. While rising rates can negatively impact bond prices, they can create opportunities in other asset classes. Rebalancing your investment portfolio to align with changing interest rate environments is crucial. Consulting with a financial advisor can provide valuable guidance in making informed investment decisions. Ultimately, a proactive and adaptable approach is key to navigating interest rate changes successfully. By understanding your financial goals, assessing your risk tolerance, and staying informed about economic trends, you can make well-informed decisions to protect your financial well-being. Interest rates are a powerful economic tool with far-reaching implications for individuals and businesses alike. Understanding how they influence the economy and your personal finances is crucial for making informed decisions. By grasping the relationship between interest rates and economic cycles, you can better anticipate how changes in monetary policy may affect your financial well-being. While higher interest rates can be challenging for borrowers, they often benefit savers. Conversely, lower interest rates can stimulate economic growth but may erode the purchasing power of your savings over time. It's essential to strike a balance between spending, saving, and investing based on prevailing interest rate conditions. Remember, interest rates are just one piece of the financial puzzle. Factors such as inflation, employment rates, and government policies also play significant roles in shaping the economic landscape. Staying informed about these interconnected elements is crucial for making sound financial decisions. By developing a solid understanding of interest rates and their impact, you can position yourself to navigate economic fluctuations with greater confidence and achieve your long-term financial goals. What are your thoughts on interest rates? Share your experiences and questions in the comments below.